is Mike Hook. I'm a lawyer here in Toronto. So I'm a member of the Ontario Bar. So the caveat here is that the focus of the information that I'm going to present on crowdfunding today is going to be Ontario information. Now with that said, where the Ontario Security Commission goes, everybody else tends to follow. And as the country sort of moves towards one securities regulator, a lot of it will be Ontario rules that follow. So Ontario is sort of leading the way on crowdfunding, at least in Canada, and hopefully the rest of that will spread. So we're going to be the test case, and I'll get into that a little bit more. So I think it's 2 o'clock now, so we'll get into the first slide here. So what am I going to talk about today? First of all, I'm going to talk about various ways that small business can access capital. Capital being money. One of the most important things for small businesses is how do you get the money to fund what it is that you need to do to get your products to market. Then we're going to talk a little bit more specifically about crowdfunding and how it exists currently, and then crowdfunding for equity, which is the big exciting piece of news coming out of Ontario, where will soon be able to sell shares of your company through crowdfunding websites. So moving on to the first slide, access to capital in Canada. So traditionally there's been a very limited pool of places where small businesses can get to money. And money has been traditionally very difficult for small businesses to get. Since 2008, since the market crashed, the banks have tightened up even more, which means that there's less money to go around and it's much harder to get to. And just by way of example, the other sort of non-bank lending structure has been individual investors who will buy into your company for a certain percentage of the shares and then use their networks to help you grow your business. That sector of the finance market has been falling off considerably, and it's now 16% or less of the total capital invested in businesses. Banks, since the 2008 crash, tend to prefer to lend to more of a sure bet, I guess is the best way to put it. So larger companies, companies that have inventory, that have equipment, that sort of stuff to secure their loans. So if everything goes south, the bank can at least realize or get back some of their money, if not all of it. So they're fairly friendly. The terms may be kind of bad for lending under $250,000, but it's that's your traditional small business stuff. And then commercial lending starts at $250,000 and up. And if you look at the $250,000 to $2 million range, which is what most growing small businesses look to access if you're buying a big piece of equipment. If you're looking to expand your facilities, you need to outfit a new warehouse, whatever. That $250,000 to $2 million in operating capital or research and development money is incredibly hard to come by through the banks. So the other way that companies can traditionally raise money is by selling shares to the general public. Now, what this means is that you would become a publicly traded company on some sort of stock exchange or a venture exchange. But this is a very expensive proposition, and it's incredibly complex and time-consuming, which, if you think about the things that most small business owners don't have, they're time and money. So when you're looking at putting together a $50,000 legal bill and probably a $30,000 accountant or finance planner bill just to put together the prospectus and the financial statements and all the disclosure documents and getting registered, it's incredibly expensive. So starting in the not-for-profit sector, we're looking at nowadays a $3 to $5 billion of money invested through crowdfunding portals. There's about 300 crowdfunding portals worldwide, of which 45 are in Canada. So that means that Canada has a pretty significant chunk of the market, and we're fairly cutting edge on crowdfunding. This money is cheap to access. The company has much more control over the number of shares that are bought, who buys them, and the return that goes out on them. and there's very little legal and accounting work that's required. Now, most companies in Canada are private issuers, and they're non-reporting companies, which means that they're not allowed to sell their shares to the general public. So as you can see, there's a big hole in the market, and there's a big gap between what you're allowed to do in crowdfunding traditionally and what you're allowed to do in your standard corporate lending. And if we can move to the next slide. So crowdfunding itself, crowdfunding is in the business sense, is basically when a bunch of small business or a bunch of people make investments in a company or a project through a crowdfunding portal. Typically smaller sums of money, so you're looking at anywhere from a couple $100 to a couple $1,000. Some are even as low as $10, $20, contribute what you can sort of thing. And then in return for different levels of donations or different levels of financial support, the company gives some sort of return. A bunch of different kinds of crowdfunding. The initial, the start off was donation crowdfunding, which you traditionally see in the not-for-profit and charities sectors, where you just go in, you make a donation to a particular cause, and out of which you might get to see a video, you might get on their mailing list, something like some sort of perk that goes along with it, or attend a meeting, attend an event, that sort of thing. There's also lending, which is peer-to-peer lending, so an opportunity for people to make individual loans, sometimes unsecured. So it's sort of another angel investor type arrangement, except without some of the traditional network benefits of angel investment or venture capital. And that's governed by your basic laws of contract, whatever the terms of the loan are. Anybody who's ever borrowed money knows that they can be kind of harsh from time to time. Whatever the terms of the loan are is what will cover that. What we see most of is in Canada is reward crowdfunding, where in return for certain levels of investment, the company kicks back different, it could be anything from T-shirt and coffee mug to pre-selling some of the product that people are making, or if they're raising money for a movie, you might see you get that $500 donations, you get 2 tickets to the premiere of it, and some complimentary popcorn or something. So something that in return for the investment, the people are getting a reward. Selling equity or shares in companies through crowdfunding is pretty much illegal in Ontario because it is considered to be a sale to the public. So the companies are forbidden from doing so, and crowdfunding portals are forbidden from allowing them to, for allowing companies to sell shares. The reason for that is there's a huge potential for fraud. Somebody goes in and misrepresents or doesn't give enough disclosure for somebody to make an educated decision on what it is that they're buying. So there is some limited crowdfunding for equity through the Mars VX, it's called, but that's really an exception to the Know Your Client requirements for securities dealers, and they can only sell to accredited investors, and most of the disclosure requirements as far as prospectus and financial statements and everything is still in place. So it's a very limited thing, but what that did is that opened the door for people who are the advocates for crowdfunding to really push and lobby to get equity crowdfunding coming in. So the Ontario Securities Commission, who are the watchdog for the public trade of shares of company, equity in company in Ontario, has just in March released their proposed rules, their draft rules for a crowdfunding exemption to some of the disclosure requirements. So what they're trying to do with these rules is to balance the need to protect investors from fraud with the huge amount of momentum that's behind crowdfunding right now. So at the end of the day, their objective is to make sure that the investors get enough information to make an informed decision on whether or not they want to invest. It, for the companies, reduces the cost of raising money from the general public and really lowers their reporting requirements, especially to the Securities Commission and to the individual investors. So these rules, they're in draft right now. They're out for comment, so for people to take a look at and give feedback on. And we're anticipating that the full set of rules will come through sometime this summer, which means that small business owners can start to try and raise money through crowdfunding. So the rules put most of the work and the expense on the portals themselves. They'll be making a whole bunch of money through the offering of this, through the providing of the service, without actually assuming much of the risk. So the Securities Commission has given them most of the work and the expense. It puts some limits on the investors, and there's a bunch of rules for the companies surrounding what it is that companies need to do in order to stay between the lines on this. So there are a lot of rules within this, within the draft rules, but the ones I'm going to touch on are the ones that specifically apply to the companies. So the rules for the companies and the rules for investors that the business owner needs to be aware of. So for issuing companies, the first stage to anything is that the issuing companies, the people who are the directors, the officers, the company itself, and the people who will be promoting and controlling the offering of stock through the crowdfunding offer are going to have background checks done on them. The extent of those background checks, I don't know, but most of it, I assume part of that will be criminal record check and financial record check. So if people are undischarged bankrupt or even histories of bankrupts, I don't think it'll go as far as credit checks or be as in-depth as it is for traditional sale of stock on the stock exchange for public companies. Each company can only raise $1.5 million a year through crowdsourcing in any calendar year. So if you put out an offer on September 8th and that closes then you can't raise money again until the following year once you've reached that cap. Must be a Canadian company with its head office in Canada, and a majority of its directors must be resident Canadians. This is a little more strict than corporate law ordinarily requires. Nowadays, it's only 25% of directors that have to be resident Canadians. But if you're going to crowdfund as a small business and you have foreign residents on your board, you may have to expand your board in order to be eligible to crowdfund. It can be a public or a private company that does this, so it's not just private and non-offering companies that do this. So companies that trade on the stock exchange can use this as well. So when you put out your offer, you'll put up a minimum amount that you're trying to raise, and sort of like euchre having to have one of the Trump suit in your hand to pick up the card. You have to have the resources once you've received the money to be able to execute your business plan. So part of the disclosure requirements will, as part of the basic information of the company, will be the business plan. So between the money that you raised and the money that you already have, you have to have enough to actually execute the plan before you're allowed to put up the offer. There's limits on advertising, where you can only offer or advertise through the crowdfunding portal itself, your own website, and social media, and they make a small exception for limited marketing materials. They haven't really explained what they mean by limited marketing materials, but most likely, your sort of information packages, your handbills, things that you would hand to people directly. So you can't advertise in the newspaper. You can't have a web campaign. All that sort of stuff. It has to be done through the portal and through your own website and social media. So when you're issuing the stock, there's limits on the type of stock that you can issue. So traditionally common shares, which are the actual ownership shares of the company, preferred shares that can't be converted into common shares, so if they're dividend producing shares, that sort of thing, or priority return of capital, whatever it is that, whatever kind of preference those shares get. Non-convertible interest-bearing shares, or shares that can be converted into common shares. So it could be options, that sort of thing. Sell options for $5, and somebody can later convert those into common shares if the company is doing well. Or if it's a limited partnership, it can be units of that limited partnership, so a certain percentage interest in the partnership. So to read into that is it doesn't necessarily have to be a corporation that raises money through equity. And at the time of investment, so there's certain amounts of disclosure before the investment, and then when the investment, when the person clicks through and says this is what they want to invest in, this is what they want to look at, this is the amount of money that they want to put in, there's an outline of the basic information about the company, which should include a business plan, information about the fundraising platform, so how they intend to raise the money and the financial impact of that on the company, and 1 year of financial statements. So the previous year's financial statement, which would show the, obviously have the money coming in, the balances from the previous year, and then the income and outflow. So not ideal for companies that are just starting up for their seed capital so much as it is for companies that are a little more established and have been operating for a year on the more traditional ways of raising money. Next slide, please. And lastly, I'll touch on the rules for the investors. There's a bunch of rules about specific investors itself, but the key ones that the businesses need to know about, each individual investor can only make a maximum investment of $2,500 per investment, and a maximum of $100,000 invested per calendar year per investor. So when I talk about the feedback that's been offered, or the feedback that's coming back to the Securities Commission, most of the feedback so far has been saying that these limits are too low. Investors want to be able to invest more. So it'll be interesting to see how the Securities Commission deals with that, and if they bump it up to maybe $5,000 and $200,000 or $250,000. There's a 2-day cooling off period. So after the offering closes, or after somebody buys into the offering, the investor's got an eject button that they can push within 2 days of the purchase, just in case they get some buyer's remorse and say, okay, well, I don't really want to buy that anyway. So the money isn't necessarily locked in until 2 days after the investor has purchased it. And then for publicly traded companies, each investor has a ban on reselling the shares of the public company, and that is designed to protect the purchaser, the people who would buy it from them, in order to keep them from buying into things that aren't a sure thing. So it's a buy and hold requirement, which they used to have for publicly traded companies on the stock market. Now not so much. And there's also an indefinite ban on reselling the shares of non-reporting companies. So if you're a private company, your typical closely held small business, and you raise up $500,000 through crowdfunding, selling off 30% of the company. The shareholders can't just go around swapping and reselling the shares. So the company's going to know who that shareholder is. They're going to be locked in. And typically, shares can't be of a small business, of a privately held small business, can't be traded without the board's consent in the first place. So this is a little reinforcement on that. So that's a very quick and dirty on the proposed rules from the Securities Commission on crowdfunding for equity. and the general state of crowdfunding in Canada. Now, before I turn it over to questions, I'll just point out I have a blog myself. The link you can see up on the screen there, mikehooklaw.wordpress.com. You can also access it from my website, intrepidlaw.ca. There's a tab for the blog with a very handsome picture of me, and blogs on legal issues for small businesses and some small business news in general. So now I will open up the floor to questions or comments.
Thank you very much, Mike. That was great. So I've stopped the recording.